Did you scroll past one of those videos claiming you get 2 checks in August and telling you to click to claim them? It is a complete scam. We are going to expose the calendar trick used by the Social Security Administration and then address something far more alarming. Your retirement benefits could be cut by 22% in just 6 years. Let us clear the air first. You are not getting an extra Social Security check in August. That is not because you were cheated out of money, but because your August payment already arrived in your account at the end of July. Even more concerning than this calendar trick is the reality that by 2032, your Social Security benefits will be automatically reduced by 22%. That is not a maybe or a possibility. It is the automatic outcome under current law. AD-generated junk videos on social media are driving widespread panic. Some people think they won the lottery, others think the system glitched, and some genuinely believe the government gave them extra cash this month. The truth is simple: the calendar is playing tricks. What should actually worry you is the ticking time bomb set for 2032, when the retirement funds you worked your whole life for could be slashed by nearly a quarter in 6 years. Let us explain what is happening right now. August 1st, 2026, falls on a Saturday. The Social Security Administration has an explicit rule. If the first of the month falls on a weekend or a federal holiday, Supplemental Security Income or SSI, payments must be issued on the preceding business day. That means the SSI payment for August was deposited into your account on Friday, July 31st. Because of this, SSI beneficiaries saw 2 deposits in July, their regular payment on July 1st and the early August payment on July 31st. So what happens in August? You will not receive a single SSI payment during the entire month. This is not a double check, a stimulus payment, or a bonus month from the government. It is simply the money you were already owed, delivered a few days early. Over the full year, you still receive 12 payments. July has 2, August has 0, and the total remains unchanged. It is as simple as that. Social Security payments for August are distributed across 5 separate dates, depending on your benefit type and birth date. July 31st was the early deposit for SSI beneficiaries. August 3rd went to people who began receiving benefits before May 1997, those getting both SSI and retirement benefits, individuals living abroad, and people enrolled in Medicare savings programs. August 12th covered retirement and disability beneficiaries born between the 1st and the 10th of the month. August 19th was for those born between the 11th and the 20th. August 26th covered those born between the 21st and the 31st. Notice where SSI fits in. It appears only in the batch sent on July 31st. Not one of the 5 payment dates throughout August belongs to individuals who receive only SSI. That is why saying there is no SSI check in August is entirely accurate. Your money arrived early. It did not vanish. There is another detail many people overlook. Social Security operates on a rule where benefits are paid in the month after they are earned. The check you receive in August actually corresponds to your July benefits. The early SSI payment you received at the end of July was for August, while the retirement benefit you get in August reflects your earnings credits from July. This lag payment structure is standard procedure for the system, not a new development. People simply do not pay close attention until panic spreads on social media. Why do so many people fall for these scams? There are 2 main reasons. First, AI-generated content on social media spreads confusion for profit. These accounts do not care about accuracy. They only chase clicks. Algorithms flag terms like Social Security, check, August, and double, automatically stitching together sensationalized scripts paired with exaggerated titles and red arrows on thumbnails. When a 65-year-old sees the words double check, they naturally click. Once inside, they face ads, requests for personal data, or phishing links claiming to unlock extra benefits. The viewer expects extra money, but gets nothing. Worse, if they adjust their August budget based on a non-existent check, the financial outcome can be disastrous. Second, many beneficiaries receive both SSI and Social Security retirement benefits simultaneously. After receiving their SSI deposit on July 31st, these individuals might receive a separate Social Security payment on August 3rd. However, these are 2 entirely distinct programs with separate payment schedules, not a duplicated check. SSI is a low-income assistance program, whereas retirement benefits are earned through payroll taxes during your working years. They happen to land close to each other at the turn of the month, creating the illusion of a double payment. Social media creators deliberately omit that these are separate programs and fail to mention that no SSI will arrive in August, misleading viewers into expecting extra funds. The consequences of this misinformation are severe. SSI provides supplemental security income to individuals over 65, as well as blind or disabled individuals who qualify. Eligibility rules are strict. Monthly earned income generally must remain under $2,019 to qualify. Asset limits are set at $2,000 for individuals and $3,000 for couples. You cannot hold more than $2,000 in bank savings, own a second vehicle, or maintain valuable investment accounts. You must meet low income thresholds to receive a few $100s each month. In 2026, the maximum individual federal SSI benefit is $994 per month, totaling $11,928 annually. By comparison, the federal poverty threshold for a single individual in 2026 is roughly $15,000. Even if you receive the full SSI allocation, your annual income remains below the poverty line. You still struggle with market rent in most cities and face tough choices between groceries and medication. While some states add a small monthly supplement, recipients in most of the country rely solely on that $994. Over half of SSI recipients receive the full amount because they have no other income sources. Spreading false rumors about double checks disrupts delicate budgets and creates real hardship. Recipients plan every dollar around this monthly deposit, balancing rent, utilities, prescription copays, and groceries. A single rumor about a double check can derail an entire monthly plan. If someone spends an extra $300 in July believing a bonus is coming, they face a shortfall in August when no check arrives. Creators spreading these rumors trade basic human survival for traffic. Now that the August situation is clear, we must turn to a much larger issue. On June 9, 2026, the Social Security and Medicare trustees released their annual report. This is an official document required by federal law, not a study from a think tank. The report states clearly that the Old Age and Survivors Insurance Trust Fund, which pays retirement benefits, will be depleted in the fourth quarter of 2032. Depletion means the fund balance reaches zero. Each year, Social Security actuaries recalculate projections based on population growth, wage levels, immigration, and tax revenues to estimate how long the trust fund will last. This year's result moves the depletion date to 2032, 1 year earlier than previously estimated, showing that the system is losing money faster than anticipated. Once the trust fund reaches zero, incoming payroll taxes will cover only about 78% of scheduled benefits. That leaves a 22% across-the-board cut. This reduction applies to all beneficiaries, including current retirees already drawing monthly checks. Some assume the government will step in before cuts happen, but these reductions trigger automatically under current law without requiring a congressional vote. When the trust fund is exhausted, law dictates that payments cannot exceed incoming tax revenues. No politician needs to vote for a benefit cut for it to take effect. A 22% cut makes a substantial difference. In 2026, the average monthly retirement benefit is about $2,070. A 22% reduction removes $456 each month, or $5,500 a year. For a retired couple who both receive benefits, the annual loss approaches $18,500. That amount covers a full year of property taxes and home insurance, buys a reliable used vehicle, or pays for a year of groceries. Researchers estimate this reduction could push over 3 million additional seniors and disabled individuals below the poverty line. This problem stems from specific policy decisions. Senator Jeff Merkley highlighted that the Tax Cuts and Jobs Act, passed in July 2025, lowered taxes for high earners and corporations while adding trillions to the national debt. Merkley noted that this single piece of legislation accounts for more than a quarter of the expansion in Social Security's 75-year funding gap. Immigration policy also plays a significant role. Many immigrant workers pay Social Security payroll taxes that support the system, but some cannot claim benefits later due to status restrictions. When immigration patterns change, the underlying demographic models shift. Fewer incoming workers paying taxes alongside a steady number of retirees widens the funding gap. Merkley attributes over a third of the expanded deficit to shifts in immigration policy. Combined with tax legislation, these choices directly impact the stability of the trust fund. The long-term deficit continues to grow. Measured as a percentage of taxable payroll, the 75-year shortfall increased by 16% over the previous year's estimate. Even if Congress allowed borrowing between the retirement and disability trust funds, the combined system would run out of funds by 2034, adding only 2 years of buffer. The accelerated timeline indicates that the financial shortfall is arriving faster than previously reported, moving the exhaustion date from 2033 to 2032 signals, increasing pressure on the trust fund. Congress has introduced preliminary measures, though their ultimate impact remains uncertain. On July 29, 2026, a bipartisan group of senators introduced the Promise Act. Co-sponsors include Democrats Chris Coons and Dick Durbin alongside Republicans Bill Cassidy, Tom Tillis, and John Cornyn. The bill does not specify tax rate adjustments, retirement age changes, or benefit modifications. Instead, it creates a process requiring a bipartisan advisory committee to hold hearings, collect input, and present recommendations to ensure 50-year solvency. If congressional committees do not act on these recommendations within set deadlines, the bill forces a full floor vote. The measure mandates that Congress address the issue rather than outlining a specific compromise. However, establishing a framework to review solutions is not the same as passing a fix. Other proposals are under consideration as well. Representative Linda Sanchez introduced the Social Security Enhancement Act of 2026, which focuses on applying payroll taxes to higher income brackets. In 2026, the payroll tax cap is set at $184,500, meaning earnings above that threshold are exempt from Social Security taxes. Sanchez's proposal would apply an 80% tax to earnings above the cap in 2028, phasing down to zero by 2032 to generate revenue for the fund. Another proposal, the Social Security 2100 Act, seeks to apply taxes to investment income as well as high earners, while expanding baseline benefits and adjusting cost of living calculations. These proposals highlight opposing approaches. One relies primarily on tax increases, while the other favors spending limits. Because neither side has reached a consensus, legislative progress remains stalled. While committee hearings and proposals continue, formal votes on comprehensive reform have not occurred. Some lawmakers, including Senators Elizabeth Warren and Bill Cassidy, advocate removing the payroll tax cap entirely. A white paper from the Committee for a Responsible Federal Budget noted that benefit taxation generated about $99 billion in dedicated revenue in 2025, accounting for roughly 5% of trust fund income. Alternative ideas include simplifying benefit taxes, increasing revenue from higher income retirees, or restructuring tax mechanisms, which could cover 10 to 20% of the 75-year shortfall. However, enacting any of these changes requires a legislative vote. Senator Tom Tillis noted that each passing year reduces the available options for balancing revenue and benefits. Adjustments discussed in 2010 could have stabilized the system for 75 years, whereas those same measures today would provide only short-term relief. Maya McGuinness, president of the Committee for a Responsible Federal Budget, emphasized that the trust fund is 6 years away from insolvency, requiring prompt legislative action. As of August 2026, exactly 6 years remain before the projected 2032 depletion date. At the same time, the Social Security Administration faces significant operational challenges. Staffing reduction plans initiated under government efficiency programs resulted in approximately 7,800 layoffs, reducing the agency's workforce by 14%. Most of the roughly 1,200 field offices lost at least 10% of their personnel. Remaining employees face increased workloads, handling higher call volumes and case backlogs. Service metrics reflect these staffing changes. By July 6, 2026, only 64.6% of initial benefit applications were scheduled within 30 days, down from 78.1% a year earlier. In certain regions, scheduling rates dropped below 45%, causing delays for individuals attempting to set up appointments. To address long call wait times, the agency reassigned 1,500 field office workers to handle the national toll-free hotline on July 6, as part of a broader deployment of 2,500 staff members. Official metrics reported a drop in average wait times from 11 minutes to 5 minutes. However, this metric counts only callers who stay on hold. Individuals who select the option for a callback are excluded from wait time calculations. The agency is also moving forward with an initiative to alter its service delivery model. An internal operations plan indicates a target to reduce in-person field office visits by more than half, capping visits at 15 million for fiscal year 2026 compared to 31.6 million the previous year. The transition emphasizes online and telephone services over in-person assistance. For older adults or individuals lacking reliable internet access, managing benefits online presents practical difficulties. In-person field offices provide essential support for submitting documentation and resolving claims. In Tennessee and Nevada, the agency is testing a centralized scheduling system. Previously, applicants contacted local offices directly, whereas the new system routes scheduling through a centralized processing framework. Representatives have raised concerns that centralized operations may make it harder to address state-specific rules, such as local Medicare Savings Program guidelines. These operational shifts occur alongside long-standing efforts to modernize agency software and infrastructure. However, reducing field staff while transitioning to new digital platforms has contributed to processing delays. By December 2025, processing backlogs began affecting service delivery schedules, extending wait times for Medicare cards and application decisions. Internal tracking data showed processing centers handling 6 million pending cases, alongside 12 million pending transactions at field offices. In May 2026, the agency paused its routine public data updates for the month. Delays in application processing have affected individuals waiting for Medicare coverage authorizations or benefit approvals. In response, 74 House Democrats sent a joint letter expressing concern that staff reassignments could increase processing times and expand existing case backlogs. These combined factors create a challenging environment for beneficiaries. False claims online generate confusion. Legislative debate over trust fund solvency remains unresolved, and operational backlogs affect agency response times. Amid these broader systemic factors, choosing when to claim Social Security benefits remains an important personal financial decision. You can begin receiving benefits as early as age 62. However, if your full retirement age is 67, which applies to anyone born in 1960 or later, claiming at 62 results in a permanent benefit reduction of approximately 30%. For example, a full monthly benefit of $2,000 at age 67 drops to $1,400 at age 62, and that reduction remains in place permanently. Conversely, delaying benefits past your full retirement age increases your monthly payout by 8% for each year you wait up to age 70. Delaying from age 62 to age 70 increases the monthly payment by 76%. In 2026, the maximum monthly benefit at full retirement age is $4,152. Though the average payout sits at $2,070, determining the right time to claim often involves a break-even analysis. Social Security actuarial tables show that the cumulative break-even point between claiming early and waiting typically occurs around age 80.5. Individuals who expect to live past that age generally receive a higher cumulative payout by delaying, whereas those with shorter life expectancies may receive more total benefits by claiming earlier. Financial advisors frequently recommend waiting until age 70 if health and personal finances permit. However, only 5 to 7% of beneficiaries wait until age 70 to claim, as many require the income earlier to cover living expenses, healthcare costs, or housing. The decision is further complicated by the potential 2032 benefit cut. Claiming early locks in a reduced benefit that remains steady regardless of future policy changes, whereas waiting to claim higher benefits later carries the risk that across-the-board reductions could take effect by 2032. Spousal and survivor benefits also depend on claiming timing. The amount a surviving spouse receives is tied to the primary earner's benefit level at the time of claiming, making joint planning essential for married couples. Evaluating expected expenses, health considerations, and benefit projections under different scenarios can help determine the most suitable approach. If you know someone relying on Social Security or SSI, share clear information with them regarding payment schedules and upcoming policy changes. Ensuring people understand that August payments arrived in late July helps prevent unexpected budget shortfalls. Understanding how benefit rules, trust fund timelines, and claiming ages operate allows you to make informed financial decisions. Staying updated on legislative updates, cost of living adjustments, and agency policy changes remains key to managing your retirement plan. Feel free to leave a comment sharing your experience with Social Security service times or your thoughts on deciding when to claim benefits. Thank you for watching, and stay tuned for further updates.